Welcome to a news update from the Sustainability Channel. I'm Thomas Stanley and I'm your host. And a few days ago, we had the elections for the European Parliament. And let's start by having a look at an article from Reuters. And it's on EU climate policies that could be slowed in the future of the rightward shift in the election. A more rightward-leaning European Parliament will make it harder to pass ambitious EU climate policies, but the majority of Europe's current world-leading green policies are likely to stay put, lawmakers, officials and analysts said. Provisional results in the European Parliament election on Sunday night showed centrist parties holding a majority, but gains for right-wing and far-right parties skeptical of the EU's Green Deal package of environmental policies and heavy losses for Green parties. And here we have a quote from Bas Eickhout, who is the head of the European Parliament's Greens lawmaker group. And he says, I don't think that we'll be rolling back on climate policies, but I do think that it will be more complicated to get new policies off the ground. EU climate measures over the next 5 years will depend on the incoming European Commission, which is responsible for proposing EU laws, but the newly elected European Parliament will get a say on every new green policy. Sunday's election results signals tougher maths to approve new EU climate measures. Another quote here from the former Environment Minister of Bulgaria, Julian Popov. It is possible that new ambition will be delayed, mostly for populistic reasons. That could have consequences for an upcoming 2040 EU climate target, needed to steer the EU towards its 2050 net zero emissions target. The EU Commission has suggested the 2040 goal should be an ambitious 90% emissions cut, but it needs approval from both EU countries and the Parliament. Let's continue with an article from the World Business Council for Sustainable Development, and it's a positive news on China's green stride forward, accelerating industrial sustainable transformation. As a dominant player in the global economy and as the world's largest emitter of carbon dioxide, integrating China into global sustainability efforts is not just important, it is absolutely essential. China's sustainability journey involves trade-off and challenges, but without China's active participation, achieving international climate goals is simply not possible. That said, the country is transitioning towards a low-carbon economy with goals to curb peak emissions by 2030 and achieve carbon neutrality by 2060, as outlined in its 14th five-year plan. When China reopened in 2023 after nearly 3 years of COVID-19 lockdown, returnees saw a remarkable transformation. By the end of 2022, 77% of urban public transport consisted of new energy vehicles, showcasing China's rapid adoption of clean energy solutions, rivaling global progress. Under mounting global pressure to meet the goals of the Paris Agreement and limit global temperature increase to 1.5 degrees Celsius, the world has turned to businesses for sustainability solutions. Chinese technologies in solar, wind, batteries, and electric vehicles now match or even outstrip Western counterparts, demonstrating innovation at scale and speed. Businesses typically aim for profitability, meeting demand and accountability for environmental and social impact. Responder to investor demand, mainland China's stock exchanges have proposed environmental disclosures for large listed companies, adopting a two-way impact approach, requiring reporting on both environmental impacts and risks. China's recent announcement of a national standard for corporate sustainability disclosure by 2030, based on the ISSB frameworks, is another stride forward, having the country align their regulatory guidelines to that of international reporting standards, which will have a knock-on effect on all businesses operating in-country. China is also committed to nurturing carbon markets, expanding opportunities for businesses to embrace carbon accounting and sustainable practices. By prioritizing lower carbon and clean energy practices, Chinese businesses can prioritize financial opportunities that drive both economic growth and environmental stewardship. Really interesting, and we'll keep having a look on the development in China. And the last article is from ESG Today, and it's on new EU sustainable fund naming rules that could lead to $40 billion divestments, according to Morningstar. Two-thirds of funds in the EU labeled with sustainable or ESG-related terms may need to sell assets or change their names to align with new anti-greenwashing rules, with stock divestments of as much as $40 billion if all were to keep their names. The new report follows the release previous month by the EU markets regulator, the European Securities and Markets Authority, ESMA, of its finalized guidelines for the use of ESG and sustainability-related terms in investment fund names. ESMA launched the new rules after noting a sharp increase in the use of sustainability-related terms in fund names in Europe over the past several years, leading to an increased risk of greenwashing. Under the new guidelines, funds using ESG, sustainability or impact terms, or environmental terms such as green, environmental, or climate, will be required to meet investment thresholds, including having at least 80% of assets in investments used to meet the sustainability characteristics of the fund and to follow the exclusion criteria for Paris-aligned benchmarks, PABs. PAB exclusions include companies with more than 10% of revenue from oil production or refining, 1% from coal, or 50% from gas fuels production, those with most revenues coming from emissions-intensive energy generation, as well as those involved in controversial weapons or production of tobacco. The new guidelines also introduce a transition category, which includes funds labeled with terms such as improving, progress, evolution, and transformation. The transition category also includes an 80% investment threshold, while applying exclusions from the EU's rules for climate transition benchmarks, CTBs, instead of the more stringent PABs, in order to enable investment in companies deriving part of their revenues from fossil fuels. ESMA also removed a proposed 50% threshold for the use of sustainable or any sustainability-related term following feedback from investor groups, but added instead a requirement for such funds to invest meaningfully in sustainable investments. In the study, more than 1,600 funds or ETFs were found to be holding at least one company breaching the PAB or CTB exclusion rules. And as we said earlier, if the funds were to sell the stocks in breach in order to keep their names, Morningstar's analysis estimated that divestments would reach up to $40 billion. So that's all for today. Over and out, and live a sustainable life.